All right. It looks like we are live and good to go. I apologize. We started here a minute late, everybody. I'm so glad you could join us. I just had a couple of technical issues. It seems like that always happens. Last minute, everything looks fine. Everything looks good right up until the second before. So hopefully everything is looking good now. Glad you could join us on this beautiful day. I'm actually really excited for this topic and especially for our special guest today. We'll jump right into this. Obviously, we're talking about the invisible influence and that mastering that subconscious decisions and that control investor behavior. And who better to have in here than Cory from DALBAR? If you're not familiar with DALBAR, they're one of the nation's leading financial services market research firms. We've had a long-standing relationship with DALBAR and Lou in particular, and Cory and I have been talking for months and preparing for this and talking about other aspects of business and the financial services industry. To kind of introduce myself, I'm the Senior VP of Client Success here at Bill Good Marketing. I've been in the industry for over 22 years, helping advisors grow their production or work half as much. Helping develop all kinds of systems in that. Also, for 14 of those 22+ years, I actually worked in an advisor's office, was fully licensed, met with clients, prospects, closed business. So very familiar with your side of the desk. So, but our special guest today is, of course, Cory Clark from DALBAR. Cory, why don't you take a minute to introduce yourself? I know you as an excellent, wonderful man that I know you're an attorney in Massachusetts or licensed. I know you've been in research. You've been in the financial services industry for a while, but why don't you tell us a little bit more about you aside from that?
Sure, Matt. Yeah, and thanks for having me. So wear a lot of different hats, as you mentioned, an attorney in Massachusetts, but that's sort of unrelated to what I do at DALBAR. But at DALBAR, I wear a few hats as well. I'm the chief marketing officer, and I'm also the director of our audits and due diligence department. And that's where I get to use some of those legal chops. But I'd say most importantly, I'm the principal author of our quantitative analysis of investor behavior report, which is an annual report that we've been publishing since 1994. Now, I haven't been the principal author since 1994, but for the last 7 years or so, I have been. So excited to share some of the data and insights that we've compiled over the years through that study in this webinar.
Awesome. And I like I said, I'm super excited about this one. It's not one that we've delved into in the past. I think this collaboration with the research and expertise that you and your team have with our expertise in communication and marketing should be a wonderful webinar. And on that note, if you have any questions, we want this to be a valuable time for you. Please drop into the chat. You'll notice there's that option at the bottom of your screen or the Q&A. I will keep an eye on both of those. And so will our moderator here. We'll make sure that we get those questions answered or point you to resources using that chat. So you may want to have that open on the side, ready to go. That'll help you throughout this webinar. But again, please do ask questions. Please do interact. We want to make this as beneficial as possible. As one of our webinars, if you've ever attended one of our webinars in the past, you know that we have set things in store for you. So very first off is our goodie bag. We want you to leave this with some valuable resources right off the bat. If you look at this long list, you'll see this is one of our more valuable goodie bags, thanks to Cory at DALBAR and the resources that they've offered out there with their prudent asset allocation advisor investor guides. If you stay to the end, we'll have a link. You'll be taken to a questionnaire. You'll answer some brief questions on how we could potentially help you, including a growth analysis and other expertise that we can offer. And then you'll be able to download these wonderful resources, including our trusted advisor identity, which is something we're going to be talking about in our broadcast today. So just please stay to the very end. I'll pop up that link and you'll be able to answer those few questions and get those valuable resources. One final note, obviously, as Bill always says, if this were a movie or a television show, you'd end up with a good 20, 30 minutes of commercials. I'm not going to do that. I'm going to give you a quick 5-minute. If you've never heard of Bill Good Marketing, what we do is a services. We help advisors double their production or work half as much. And we do that through a number of ways. And I like to say that the primary focus of our push is through relationship building. And that happens with existing clients, prospects, strategic partners or COIs out there in the industry. And we help you with every aspect to do with that, including the content needed to send messages out, scripting necessary, questionnaires you can use, and then also the best practices that we've worked with advisors and developed over 4 decades that we've been in this industry. I think if you pair the wonderful resources and expertise that we have with the research and expertise that DALBAR provides, you're set to be well ahead of the game, which is obviously one of the things that we were talking about in our promotion to you, which with that, I'm going to go ahead and stop sharing so you can actually look at us. In our promotion, we talked about some of the key things that you're going to be able to come away with this from this webinar with, and I want to make sure that we deliver on that. Because really what it came down to, and Cory and I were having conversations as we were discussing how we could take the expertise of DALBAR and Bill Good and pair them best in a webinar. And one of the things in particular I've been noticing is that, in the industry, we have a big problem. And that big problem is that we don't tend to stand out. Every advisor starts to look the same. And that's backed up in that I've seen different numbers on it, everywhere from 43% to 60%. And I think it all has to do with the question. But that percentage of investors feel like all advisors either offer the same promises or do the exact same things. Obviously, we don't, right? And that's what we want to overcome in our communications and our efforts there. And really what, to me, that comes down to is we have to set ourselves apart in our clients' minds and become that trusted advisor. But there's a lot of aspects to that. And as Cory and I were talking, I came up with 3 things, and I call them the 3 Ps because the Ps are somewhere in the lettering, and the 3 Ps sounded nice and pithy. So we're going to go with that. But if you take a look at really what we see is that in order to establish a great trusted advisor identity and stand out, especially at this time amongst your clients and prospects, is to, first off, you have to offer everybody protection. And we'll talk about what that means, but you also have to offer periodic reviews, and those have to be productive, right? And then finally, we have to offer a plan. We have to have a direction. We have to have a focus to stick to. And let's delve into each one of those areas. But obviously, as you have questions on any of those, please drop them into our chat. So really, I'm going to turn to you for this, Cory, because you're the expert on this area. So in the area of protection, I look at that as kind of 2 sides, right? That first off, we actually have to protect their investments. But then number 2, we have to make them feel protected. And you guys have done a lot of research in both and studies on both. So why don't we start with, methods of actually protecting? What have you guys seen in that regard?
Well, certainly you have the protection that exists in the investment management or financial planning context, whether it's just a diversified portfolio or whether it's cash or cash equivalents and things of that nature. But if we go a little bit further, what we're seeing is more advisors and more institutions trying to put a focus on financial planning and some of the types of decision points that a consumer isn't going to typically be able to get through automated means. So that might be hedging strategies or creating guaranteed income streams. When should I take Social Security? How do I optimize my income and assets for Medicaid or Medicare? So we are seeing a large shift towards those type of more qualitative, I guess you could say, types of conversations. But then there's the protecting investors from themselves, because it really doesn't matter how great the plan is if the investor won't adhere to the plan, if they're going to deviate from that plan under market stress. We all have seen documents or things out there that something to the effect of, if you miss the 5 best days in the market or the 10 best days in the market, what it's trying to get across is that one bad mistake is going to compound for the rest of your investing career. and that can make a really big difference. And so, what we're seeing a lot of institutions and advisors trying to do to better engage both the clients they have today and the clients that they want to secure for tomorrow, that conversations around behavior, psychology are a way to differentiate from these scalable automated service models, or from index investing. All the macro trends that are commoditizing the industry right now. That's the way that it's being combated today.
Well, definitely, and I find that interesting, and I kind of want to delve into that further as far as the overall investor behavior and how we're managing for those various behaviors. And as you and I taught, obviously there's tons of different behaviors, there's tons of explanations for different things, but I think you could probably pinpoint some of the big ones as far as main behaviors that investors have. And let's talk through those a little bit. So one of the things that you and I discussed is this whole idea of loss aversion, and the kind of twist that goes on in investors' minds and having to do with that. So why don't you kind of take it away there as far as what is loss aversion, and then what do investors do with that behavior?
Sure. Yeah. So there's probably quite literally hundreds of investor or behaviors or heuristics, not investment. But when you talk about these behaviors or heuristics in the investment context, it's almost always going to intersect with loss aversion to some degree, because it's probably one of the most important. And so, loss aversion isn't just the fact that investors don't want to lose money. I mean, none of us want to lose money, and that's a given. But that's not really what loss aversion is about. Loss aversion is more about the disproportion in pain you feel from a loss versus the joy you get from a similar gain. So, if you had a hole in your pocket and $100 fell out, you might feel an 8 out of 10 on the frustration scale that you just lost $100. Whereas if you found $100, you might only feel a 5 out of 10 in the joy scale for finding it. So what does that mean for investors? What does it mean for advisors? What it means is when the number is in the red, it has a different psychological effect. And so the sort of the term that we use, and we talked about this in the last quantitative analysis of investor behavior report, which was published last March, it's the enemy you know and the enemy you don't. The enemy is, I would say, could be illustrated perfectly through 2022's returns. You had the S&P 500 that lost around 18%. And then you had the average investor that lost about 300 basis points more than that, or so, roughly speaking. And that's typical. I mean, that's what we see, around 300, 400 basis points. And that's very noticeable because they've already lost money. They've lost even more than the market would indicate, or what they would expect if they're looking at market returns. But it's the enemy that you don't know that is perhaps more problematic. And the reason that investors may not know it or be as aware of it is because of loss aversion. They're going to pay attention to a loss, but an economic loss won't have the same psychological impact. And the poster child for that, and I'm sorry, it was 2021 that I mentioned, but I meant to mention before. That was no, 2022 was, and this is 2021 is the example of the enemy you don't. Sorry, again, the year when the market did spectacularly, and so did the average investor. In a vacuum, they earned over 18%. So there probably weren't a lot of investors that were feeling the type of pain that they may have felt last year, but in fact, they left over 1,000 basis points on the table. So, that's pretty significant. So that sort of illustrates in 2 consecutive years, the enemy that you don't, which the enemy which was last year, versus the enemy that investors may not really know or that they're not. It's not in their perspective. They see that they earned 18%. That seems like a great result, even though they left over 1,000 basis points on the table.
Well, and I think that kind of illustrates a point. And I'm going to stop sharing just so we can kind of get back to us. But the fascinating thing that I've found is any year like this one, where we've had a lot of different negative news I mean, the news cycles are almost always negative. Everybody's always talking that because that's what gets headlines.
It's a
But
read. Right?
yeah, right. So they're always negative, but it seems like we've had a lot of different economic notes out there that seems like they should actually have a major effect. But I was looking at it before our call. We're up year to date. I mean, even though we're down a little today, year to date, we're still up over 15%. And I've found this fascinating thing that in talking with advisors all around the country and throughout Canada, that this year has seemed like it started off great for those that were doing some great marketing and things were looking good. And then kind of through the summer, we kind of hit this stage, and I've seen this multiple times in my career. Those that are on the call, you've seen it also, where the news, the negative news kind of becomes old hat and it no longer moves us, right? It no longer is inspiring or anything like that. And more so we move into this stage of, I'm good where I'm at. And that comes to this other stat where 93% of investors are satisfied or very satisfied with their current financial advisor. And yet, what I also find fascinating about that, in the same study that was conducted, they found that only 31% or 31% of investors felt like were not confident in their financial plans. And those two don't match up. I feel like my advisor is doing a great job, but I'm not confident in my financial plan. And we think that those should match up. And in years like this, when investors can get complacent because of the market and they're busy and things are going on, that's where advisors have a hard time winning over new business. But I think coming into the fall, we have this opportunity. And this was where some of these other behaviors might come into play in communication with your existing clients, number one, to retain them, but also as you're talking to prospects. And those have to do with the herding behavior, which I know you guys have looked at a lot. And then also in that fear of missing out, which is a newer term applied to investors, but it's been around for a long time. But so why don't we talk about herding and herding behavior? How do we address that with our existing clients first off? And any desire to go with the crowd, and then how do we address it with prospects to get them to move away from the complacency?
Yeah. So with current clients, it's good to have certain talking points that they'll be able to relate to, and I think that sometimes just bringing up these behaviors and making the investor aware of their existence can go a long way. So, for example, in this example, I'm going to bring some related heuristics in because there's no clear lines here. Everything, it's a tug of war. It's overlapping circles. It's complicated. But you have herding. So one talking point could be ask the investor how much of a temperature gauge of the market is the herd. Is what the herd doing indicative of where the market may go? Is there some predictive quality to what the herd does? And the answer is unequivocally no. In fact, probably the opposite. And so the quantitative analysis of investor behavior is one way of getting that point across through data. And we've seen, again, since 1994, we're measuring what an average investor is earning and comparing that to the index. And in most years, not every year, but the vast majority of years, the investor is underperforming the index by quite a bit, like 2 years ago by over 1,000 basis points. So if this is the case, if the average investor so rarely even is able to earn what the market earns, how could we possibly think that the masses or the herd is somehow indicative of the direction of the market? It's not. So just from a logical perspective, and every investor sort of knows this, but when you show the data, it crystallizes it, that you don't follow the herd. If everyone knew the way the market was going to go, if the herd was correct, then everyone would be a millionaire in the stock market, right? So that's one. Some other related behaviors that I think are important are confirmation bias and media response. And so one thing to keep in mind, and this is another good conversation to have with an investor if they're coming to you and saying, well, I'm scared about what the market's going to do. I read this, I read that, and they want you to augment the plan for, because of that. And maybe that's something worth considering. But if you feel like this is media response or hurting, one thing for an investor to keep in mind is confirmation bias. If you have a fear that the market is at a top and there's going to be a correction or a crash or something, and that's a fear that you have, you could read 5 headlines, 4 of them talking about the resiliency of the market and how it's heading upward and onward, and one article with a headline saying that the crash is coming. And that's the one that an investor will take greater mental inventory of, because it's confirming the suspicion that they already have. So where they're left is they feel like, well, everywhere I'm reading, I'm seeing these headlines that are confirming my fears. It must be true. I must need to act on it. When in fact, that might not even be the case. For every article that you read about the market going down, there's an article about the resiliency of the market. But what are you going to remember? What are you going to take to heart? What are you going to take inventory of? It's going to be that which confirms what you already believe, your preconceived notions. And so that's an important thing to remind investors, that if they feel like media is confirming their fears, that there might be a psychological element at play.
Yeah. Well, I love that too, just as far as the acknowledgement of the fact that these things are out there. And it is your job as the advisor to keep them from that, right? To keep them from the negative effects of those different behaviors that are possible with investors out there, and the experience of the advisor in handling those behaviors, I think is a good thing. And honestly, that really starts with setting good expectations, right? With every investor that you're meeting with. That includes prospects and setting these expectations, even in presentations you're giving into public groups. I think that helps to set the stage, especially with the other one of fear of missing out, with this whole idea that, yeah, there's this winning stock or winning idea. And you and I talked about this because I saw it a lot when I was in the industry and talking to existing clients and prospects. This whole idea that Bitcoin or any of these digital currencies were suddenly going to make everybody a millionaire. And people were calling in and wanting to know, well, how do I get in? How do I get involved? What's one of the ways that, because as I know you and I talked about, DALBAR has these thoughts about structuring portfolios to allow investors maybe some leeway in the fear of missing out, but also some structure and organization in that. What have you guys seen, and how's that worked for investors in managing that?
Well, certainly if you have an investor that is interested in a particular asset class or a new asset, cryptocurrency being the perfect example to just use as a hypothetical. If you can't provide access to that security, either directly or indirectly, somehow provide access to it, and it does well, I mean, you're certainly taking the risk that a client is going to see, their friends and family that were invested in cryptocurrency, or they're seeing influencers with the screenshot of their app and the money that they're making, and they feel that they can't get access to those things through then that's a risk. But at the same time, there's a risk on the other end, just the same way that the investor's taking a risk is, if they get burnt by it, they're probably going to blame you. And so, really, I think that for an advisor, maybe there are other ways to provide access, other ways to fulfill their desire to be invested in a certain asset class. Maybe it's not investing in cryptocurrency, but investing in stocks that benefit through cryptocurrency's growth. Or but another thing that we've talked about a lot with advisors when we're consulting is what we call purpose-based asset management. And if you have a certain sliver of your portfolio that you use that's for those speculative assets, well, then as long as it's a prudent proportion of the portfolio, then you may have an opportunity to provide them with access to that and implement it into the portfolio in a prudent way. But sort of segregating that account and those funds for those speculative type of investments, and really segregating it, not even having it part of the same account, is what we've And what we've heard a lot of advisors do want to do. I mean, they want to be able to give their investors the opportunity to scratch that itch, but do it in a way that's prudent and under their supervision.
Yeah. Well, and I think that's the key there too, is honestly, so many investors are going to scratch that itch. To use that term, they're going to do it. And it might as well be in a controlled manner under the direction of the advisor, where they can actually help and provide guidance and limits, right? And keep them within the whole purpose. And I think that's the ultimate key here, right? So one of the things that we always recommend is hand-holding and in making sure that your clients are constantly hearing your viewpoint and your ideas and advisor as far as what's best to move forward. And to me, a great hand-holding message, and that can come either over the phone in a meeting, which we'll talk about in a minute, or through email or a letter, and preferably a letter. Email, I know, is faster and you can get in front of people quicker. But my concern with email is open rate, right? The average open rate for email that I've seen with existing clients is around 40%. I've seen as high as 60%. But either way, that still leaves either 40 or 60% of my clients without that message, right? Without that note from you. And in which case, what are they hearing? Well, they're hearing that negative news that we've already talked about, the crazy things, or they're getting that confirmation bias by reading that one article that confirms every fear that they've ever had. So that's the idea of handholding. We need 4 aspects to be in place in order to have a great handholding message and combat that fear of existing clients. And number 1, it has to always provide perspective, and that perspective should be exactly on what you were talking about, Cory, and that is the ultimate purpose. What are we trying to achieve for this investor? What is their goal? Right? Because we know that gain, that is actually what's going to drive them. They're going to move forward to achieve that purpose. And so we want to make sure that we point that out in our handholding messages. Number 2, we need to provide education, right? Investors need to understand exactly what's happening, not what the media says about it, not whatever bias is out there that might be there, but what you see is happening right now and how that affects their purpose, right? And that kind of comes into the next piece, which provide some history. I mean, we all know that past performance is no guarantee of future results. Everything could be different tomorrow, but it does provide some guidance. I mean, looking at the numbers that you showed in the history of the average investor's performance, that does help us see exactly what's needed and what to avoid, right? To stay away from the crowd. We don't want to join the crowd in their investment views. So provide a little history and what's going on, and that perspective will help. And then finally, and this is one where I've seen, I'd always be interested in your thoughts on this too, is that clients want to action, right? When there's negative market movement, if the market goes down, if we were to suddenly have a major downturn, kind of like we did in 2018 or some of these other years, where it's just this massive drop, investors want to do something. They want to have control over something. Tell them what that is, right? Maybe the control is strictly over their behavior. Maybe the control is over that play account that we've set aside for them. Maybe the control is, if you're a tactical investor, maybe you're going to move more to cash for them based upon indicators, whatever it might be. But we have to give them that idea of the control and that feeling of comfort. And one of the things that we talked about is the benefit of even having some fixed income or even some annuity kind of products within your portfolio. To provide maybe some of that feeling of areas where we have control. And what have you seen on that front as far as that control side?
Yeah, I mean, when you have underlying guarantees, and then it has an effect on behavior. So we looked at variable annuity subaccounts and compared that to the analysis that we've been doing for 20 some odd years on mutual funds. And these aren't different investments. I mean, in some cases, they're actually the same investments, but it's the behavior. How does an investor behave when this is a portfolio of subaccounts that has certain guarantees attached to it versus a mutual fund that doesn't? And what we've seen is the investor behavior is much better and the returns are better. And again, it's not about the returns of the investments. It's about timing, and the market timing. In some ways, some degree of illiquidity is okay. There's probably a lot of investors that maybe overestimate the amount of liquidity that they need, but sometimes lack of liquidity helps behavior as well. There's a lot. Like I said, there's a push, there's a pull. It's messy. There's no clear lines. Like for example, we're talking about fear of missing out in a negative sense, but we've written articles about FOMO from a positive perspective, and the fact that when people flee from the market, like 2020, when the pandemic hit, there were many investors that were out of the market waiting for that time to get back in, and they start to see the market recover. We want FOMO when we're talking about investing generally. When we're talking about FOMO with a specific asset class, we're probably talking about the beginning of a bubble, maybe that's developing. But FOMO is kind of like a strange behavior in the fact that in a lot of cases, we want investors to have the fear of missing out on the market recovering from a downturn, so that they're not selling low and buying high.
Yeah, and the loss aversion and anything else that's kind of taking over in their investments, again, lead them to poor long-term behavior. So, but I think again, it does come back down to that focus and that perspective, and that to me is really where productive portfolio reviews can take place. And honestly, it's one of those words, honestly, as far as portfolio reviews, I hate that word review, right? Because it shouldn't be just a lengthy discussion about what's happened in the past. It should be about what's happening now and what's going to happen in the future. That's the whole purpose of investing, is what's coming in the future, and managing things now to get there. So I would prefer it wasn't just about reviews, but let's talk about portfolio reviews. And one of the questions that we often get here at Bill Good is, how often is enough? How often should we be reviewing with our clients? How often should we be in front of people? And I would say really kind of there's two aspects to that. Number one is capability. One of the things working with advisors that I found fascinating is we're helping them double their production, which obviously includes a growth of number of households you're working with. They didn't take that into account when they set up their review schedule with their clients to meet with a client every 3 months. And now suddenly, instead of having 50 clients that I review with every 3 months, which is possibly doable, I have 100 clients to meet with every 3 months. And now suddenly my days are going long. And then if we get up to 150 households that we're working with, can we continue that same promise and fulfill it? So that's number one, is can we actually follow through and have productive client review meetings with them if we have too many, right? If we're trying to meet too often. And there is a level of lack of productivity, which is number two, in those meetings, right? If we're meeting every 3 months and all I'm doing is reviewing your quarterly statement, that's not necessarily helpful. And now I'm not providing a benefit to the client. And so what we've seen actually in productive reviews is every client has 3 questions, and you need to answer those 3 questions. I'd love to hear your thoughts. I know we didn't talk about this, so I'm kind of throwing this at you on the side here, Cory, but the 3 questions I've seen investors always ask of their advisors is, number one, am I okay? Right, which has multiple layers to it. But number 2, what are you doing for me as an advisor? And then number 2, what value am I getting out of this? Right. And that's, return, it's, cost associated and all of those aspects to this. What's the value that they're pulling from this? And again, I'm just kind of tossing this too. I know this doesn't necessarily fall into the QAIB or anything like that necessarily, but in your experience, Cory, what have you seen in great productive review meetings?
Well, every client's a snowflake, to some degree. You're going to have certain clients that have an expectation to meet with you, every quarter. Now, I wouldn't necessarily make that the default cadence for all of your clients for the reasons that you just mentioned. But I think if you have an annual review, mm-hmm. and periodic reviews that are based on life events, and I think that's the key. Depending on the complexity of someone's situation, maybe they should meet every 6 months, maybe it's once a year, but no matter what investor you are, what your situation is, uh, everyone is faced with life that changes on a dime. Somebody gets a new job and income has doubled, or somebody now, their aging parent has moved in and they now have to care for them. I mean, I could go on. I mean, there's a limitless amount of scenarios that can meaningfully change the plan. And that I mean, obviously, you need to have sort of periodic review to make sure that too much time doesn't go by. So maybe it's a year, maybe it's 6 months, but more than anything, there needs to be a mechanism so that the investor understands or is invited to communicate life changes with you, to understand that when a life change comes about, that should prompt another meeting so that you can discuss what that life change means in terms of your portfolio, your plan, and everything else that goes around that.
Definitely, I would agree on that 100%. And I think really, to me, that communication comes into the system and consistency at which you meet with your clients. And then making sure that those meetings, they understand the format, the structure, and always having, to me, in my mind, what's next, right? What are we working on next with that client to get to that ultimate purpose? And as long as we're consistently driving to that ultimate purpose, that is going to keep us away from some of these other negative investor behaviors fairly well, because then it's just keeps that perspective on all the news and everything else that's coming at us. And I think ultimately that's our goal, right? And then one of the aspects to this, though, is obviously we're going to discuss, part of that question of am I okay is performance. And one of the things that in talking with advisors, there's always this lack of confidence in performance. Some aspect of it is that, hey, I've way outperform the market. But most of the time when I talk to advisors, it's, hey, we're at market, maybe we're slightly below market at this point, or, hey, the market's down, but hey, so are we, but we're not as down as much. What's the best approach in discussing, performance of the portfolio with clients?
It's got to be based on the goal. I mean, what we see most, institutions doing, as part of their broader repeatable process is doing simulations, doing a Monte Carlo simulation. And if you reach your goal, 90% or more of the time, you're in the green zone. If you're, 80% to 70%, then you're in the orange zone. So it's really trying to harken back to their goal. And this can really help, particularly when, if the market's down and that loss aversion is creeping in, to be able to, just set better, expectations. And you mentioned value as sort of that second question. That one's a really hard one, because what are we talking about with value? Are we talking about how much more investment return? Is it the fact that maybe you contribute more because you have this relationship that has you more focused on your financial goals? Is making a more prudent decision to when to take Social Security? So it's easier to quantify if we're just talking about rate of return. It's a lot harder to quantify when we're talking about those other things, but that is what advisors have to do. And maybe they can't quantify it in a number, but at least communicating to them, that these are the services that I provide. Like, this is the breadth of what a relationship with me entails. And it's not just, I've got an investment for you. It goes well beyond that.
Almost definitely. And I think the key here is, as far as the helps and all of this communication that we've been discussing, there's lots, right? And I know, DALBAR, you have some great research to show the numbers to help in these discussions with clients, to show them, what to avoid, right? And what to be looking for in great investments, and what are some of the performance of things out there, and even helping advisors in their research to find those things that are going to help them in the actual portfolios and the products and everything that they use there, to help them provide the best options there. I think in the communication that you're providing clients, and then we'll talk in a second about prospects. In that communication, like I said, we want to make sure that we're getting across those four main ideas with hand holding. Obviously, Bill Good Marketing, that is what we excel at, is in writing content and getting that kind of communication out to clients, and making sure that they have all of that information available to them. And so then The final piece to this, of course, is that we do send out letters for advisors. So if you have a need, I mean, if you don't have the team and structure to go out there and grab letters and send them out yourself, we have a program where we can actually set up and send emails for you using the great content that we have with great feel-good messages, goodwill messages, market education, just some great information out there. It's a program we call Presence. There's going to be a link in the chat. You can take a look at it, gather some more information on that, but it'll help you in that education phase for your clients and keeping in front of them with the materials and information that you want them to see, not necessarily with what just the news cycles are presenting to them. And that kind of comes to this final thing. So having a plan, right? And we've talked about that a couple of different times about having that plan as the perspective that we're going to lean to, making sure that everybody has a current plan and consistently you're updating that. But do that on a system, right? So in our software, we use it's Gorilla 5, whatever CRM system you have, you need to have a set review time period with every client. And Cory, per your statement too, I agree with that it should be by client, right? Yeah, we may default that all top clients normally are every 3 months, but maybe Bob Jones, who's a tier 1 client, doesn't need that, right? Maybe meeting with him every 6 months or every year makes more sense given where he's at in his relationship with you and his trust level with you. And, maybe it's every 6 months because, he's some changes going on now that he's hit certain ages. So there's different aspects to that, but that plan should be a key piece to that overall aspect. So if you've gone through your client list and you're looking at your clients and you see how many of them have a written plan, hopefully that percentage is 100% in your top 2 tiers at least. In your top 3 tiers, it should be over 80%. And then maybe your bottom tier can be lower, but the more people that have the plan, the easier it's going to be on you. And I can't stress enough the importance of have that being written. I know it's a living thing and it kind of just keeps going and getting adjusted and changed, but having that physical copy in hand is extremely important. And what we found, and the reason for it, is that investors, well, all of us people in general, within, I think it's 48 hours, we forget 70% of what's been told to us. Having that thing in hand or sitting on the kitchen counter or the dining table allows us to see and allows your clients to see on a regular basis that value you provide through that planning process. And that kind of leads to this whole idea of prospecting. In your messaging and everything else that you have going out there, the best form of prospecting is, of course, introductions and referrals from existing clients. And that's what we want to continually push out there. In that aspect, one of the things we also know is that most people are going to look you up online before they actually come and see you or even follow the advice of a friend to come and give you a call. And Cory, you guys put together some great material or some thoughts on making sure that as far as the online reviews for you, how to go about that, what are some of the rules surrounding that? How do we make sure that clients are out there talking a good story about us and that's actually helping our view?
I mean, I'm sure most of the viewers are aware of the fact in 2020, the new advisor marketing rules were promulgated, and it hit on a few different things. One was testimonials. Another was hypothetical performance. And it provided some, and there was others. That wasn't, but those are the ones that I'm talking about now. It also provided some clarity around social media and these digital, referral type of sites, which, back in the 60s when the advertising rules were developed, obviously nobody, had any idea what was coming, and they weren't written for the technology and the way that we market today. So one thing I would say is always be careful about hypothetical performance. I know that wasn't the question you posed to me, Matt, but I feel like I'd be remiss if I didn't bring that up, because there has been several enforcement actions over the last few weeks around hypothetical performance. So if you're advertising anything that has performance that wasn't a portfolio that you actually managed, you need to be very careful about that. But in terms of social media or referral sites, essentially, if somebody goes on your Facebook page and provides a great review or something, no, you're not. That can't be attached to you, right? Unless you sort of ratified it or were involved in its creation. So what an advisor needs to just be making sure is that they're not manipulating the way that information is being presented to the public. And the perfect example of that is you get a great review on your Twitter or Facebook and you pin it so it's always at the top.
Mhm.
And somebody else may have tweeted something or that may have been not as not as favorable, not as flattering, and that gets buried after many more posts while the good ones are being pinned to the top. So that's something where, yeah, you didn't control what somebody wrote, but you controlled how it was displayed. In those cases, you just want to make sure that it's just being displayed organically, and that you're not influencing that in a way that would misrepresent or would be misrepresenting yourself. Another thing that it talked about, what, like I said, is referrals, testimonials, all of those things. So, they're on the table. There's just rules around them, so if you're paying for a testimonial or you're paying for a referral or solicitation, there's disclosure rules. I mean, it's complicated. It's not something that I can necessarily explain here, but just to understand, if you're talking about referrals, if you're talking about solicitations, if you're talking about client ratings, or hypothetical performance, you should speak to a compliance professional or speak to your back office to make sure that you're not running afoul of any of these rules, which are fairly new, and people are still trying to get familiar with what the SEC, where the line is. So it's something to definitely keep in mind in your marketing efforts today.
Yeah, definitely. And you can take a look at, I know on your website, you've got in the resources section an article on that can help with kind of expound on that. But I want to talk a little bit about the referral promotion that you're running with clients, because what we've seen in particular with existing clients and creating that advocacy is training your clients on what to say. And there's really three parts to a good referral promotion, which, of course, if you know anything about Bill Good Marketing, you know that we tell you never to ask for referrals. I think there was one time I heard an advisor that actually asked the client for their phone so they could get a list of names of people to call, and don't do that. That we look for promotion, and a great referral promotion has three parts to it. And number one is letting the client know what to look for, right? To see where you help, and that comes in and saying things like, currently there's a lot of frustration and anxiety about the economy and the markets. I found when people are frustrated or anxious about what's going on out there, it's because they're not hearing from somebody like you hear from me. Right. So now I'm telling them what to look for. They're looking and listening for somebody that says they're frustrated or anxious about the economy or the markets. And I'm telling them now the benefit, the reason why that's a problem and how we can help. I'd love it if you hear anybody expressing their frustrations or concerns about the economy or market, please send them our way. I'd love to help alleviate those concerns, right? And I can even add in a little bit at the end of, in fact, if you come across anybody like that, why don't you set up a time, give us a call. We'll coordinate a time. Maybe we can meet over coffee and have a nice discussion, or we can include them in our regular mailings, include them in our email blast that we'll be sending out. But just giving them those very specific things is helpful as you're training your clients in what to look for and how to send you new business. And then provide opportunities for them to introduce new people to you. And that can be done through events, of which we have tons of documentation on how to run great client events. We even have some great lists of ideas of events that you can run that will help you get in front of client friends. And again, kind of change this narrative from constant discussion about performance of the S&P 500 and put it into just life and that perspective in general. One of the questions we have in chat, I kind of want to address, and he says, we talk about at Bill Good Marketing, we talk a lot about snail mail. And the reason why we talk about that is because it does stand out from the email. The average person receives well over 100 emails a day, whereas letters, I think we would all be a little crazy if we received that many letters every day. In fact, I think the last time I received a letter was months ago. I received bills and coupons and voter things, but I don't receive letters from people. So letters stand out. Number one. Open rate is another reason why we push snail mail over email. But that being said, in the case of a significant market movement where there's going to be fear, there's going to be anxiety, there's going to be this desire to control something, I need to get a message out. I need to communicate to clients quickly and immediately as to what to think, what to do, how to act, right? And how to understand what's going on, providing that education. So getting an email out immediately is great, right? We need to do that. But just make sure that if you have any clients that don't read email, don't open email, have never shown to open email, log that in your CRM so that you actually can send those people a physical hard copy. And then the third layer that I would put in there, and it's one of the things that we used to do, is I knew there were set clients that just were always nervous. They had that fear and anxiety about any loss, period. And so anytime the market made a movement, they were going to call into the office. And I knew if I waited for them to call us, then that was going to be a good 30, 45-minute phone call because there was a story to tell. There was something that they had to get off their chest before then we could address it and provide the education and calm and proper perspective that was needed. But if I called them first or sent them an email first, depending upon the client, then I could alleviate that need and make it a much quicker phone call or touch so that I could get on and move on to other clients with that same communication. So mark your clients, mark them as, hey, this person's nervous. These are one of my nervous clients. These are one of my, high hand-holding need clients, however you want to label it, but just label it. So that when times come and these market shifts happen, which, they're going to happen, we all know it does, you know how to target those clients and can do so with that clear message quickly and easily. And that's actually one of the other things we do is we provide hand-holding messages that provide an education, that provide that proper perspective, that push things out into the what can I control and what can I do. And we usually have a letter if there's a big market movement or something going on, we'll have a letter within a day or two ready to go. And we'll send it off to several of the compliance offices we work with. All of our material is pretty well compliant. The only reason why it doesn't get approved if somebody else wanted to say it differently, but otherwise we follow all rules and guidance. And then we also provide video scripts for you to be able to go out there and provide scripting, and then also use scripts that you could use to contact your strategic partners, your CPA partners, your attorney partners, and provide some context and talking points for them to use with their clients, which can also help with this whole messaging. So hopefully, Curtis, that helps answer your question of how we're going to get this message out and help alleviate some of these investor behavior concerns. I think the kind of final point I want to end off here on, and if there's any other questions, please drop them into the chat. But Cory, I'd love your thoughts on this point, and that is that every advisor out there needs to show their expertise, needs to show how they're different, and needs to show that their willingness to communicate. What are some of the best ways you've seen for advisors to be able to do that with their existing clients, but then also as they're meeting with prospects? What helps them stand out?
I think it's about customization, which plays off of what you were saying pretty nicely, Matt. In terms of the example you gave is if somebody's nervous, you indicate that in your CRM, and I think just knowing. Essentially, when the reason why I think we're talking about investor behavior here is it's sort of like an old school form of predictive analytics, right? We talk about AI and predictive analytics to try to customize our messaging and try to engage with whether it's a current client or a prospective client with content that matters to them. And so if we think about investor behavior, we have a form of predictive analytics in a way, is because we know how human beings are going to respond to certain stimulus. And so when that stimuli is out there, you know that there's a market correction happening, you know that there's or the opposite, the market is soaring, and we can say, not for each individual investor, but generally speaking, this is how investors are thinking and behaving, and this is what's worrying them about it. And so if you know that, and you can understand some of these different talking points and some of these psychological phenomenons that are going on, it's a way to customize and engage that client or prospective client in a way that's sort of customized, although it's not customized, but we know what's going on in a human being's head right now, for 9 out of 10 people. So use that information as a form of predictive analytics to customize your messaging and engage in a way. So the messaging that you might put out there and trying to engage with a prospect during a market downturn is going to be very different than during a bull market.
Of course.
But due to loss aversion, one could make the case that during a market downturn, that's where the greatest opportunity is to capture new clients, because that's when clients with other advisors are going to be questioning that relationship, and that might be the time where instead of it being a threat to you, it's an opportunity for you. So yeah, in terms of communication, I think it's trying to use whatever you can to engage with that person in a way that's going to be the most meaningful. And this is a good way of doing that without psychoanalyzing each and every individual investor that you have, but we can make broad assumptions and know, just from a scientific perspective, that this is what's going on psychologically. What sort of messaging can I put out there that relates to that and is going to speak to them based on that psychology?
Yeah. No, perfect. I can't agree more. So I think that's good. And I think that's just respectful of everybody's time. I know we're running up to the end here. I do want to share, of course, our goodie bag. Thank you to those that were able to stay to the end here. You can see that this is a great group of materials and guides that you can download for free. We just ask you to go to this link. There will be a link also in the chat, so you can just click on it rather than having to type all that in, and answer a few questions. Obviously, there's a piece to that as far as what services we can help you with and how we can help you get out there in front of your clients and prospects better, especially as we're ending the year and everybody's making this big push. These are some ways that we can help you get that done. So answer those questions, and then you'll be able to download all these guides, including that BGM's Trusted Advisor Identity, which is the key to be able to get out there in front of people in the right light and kind of distinguish yourselves. But thank you, Cory, for your time. Thank you for joining us and lending your expertise. Obviously, if you want to interact with DALBAR, you guys have your QAIB report. And that's an analysis that you guys run. How often, again, is it an annual report or research?
Yeah, we do it. Yep, we do it every year. It's published usually at the end of March, and it covers the preceding calendar year.
Perfect. And so yeah, please definitely let us know how we can help, and hope you all have a great rest of your day. Thank you.